Hey everyone, welcome back to Corporate Decoder. Today, Magnachip Semiconductor Corp MX just filed an 8K announcing a new stock sales agreement, and I am seeing a move that could shake things up for investors. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing reveals a plan to raise up to $50 million by selling more shares, and we need to understand what this means for the company's future and your investment. Alright, so what is the big news here? Magnachip Semiconductor, or MX, as it is traded on the stock market, has announced it is entering into an at-market issuance sales agreement with B. Riley Securities. Think of this as a deal where the company can sell its stock, its common shares which represent ownership, up to a total value of $50 million. They can do this over time and use a financial firm, B. Riley Securities, to help them sell these shares as their agent, or B. Riley might even buy them directly. This event happened on June of 2026. The date is important because it tells us when this agreement officially kicked off. Now, Massachusetts Magnachip is a company in the semiconductor business, which means they make those tiny chips that power everything from your phone to complex servers. You might know them from their stock symbol MX trading on the New York Stock Exchange. The shares they plan to sell are common stock, and each share has a very small nominal value, just 1 cent. This might sound small, but it is standard. What is more significant is that these shares are listed on the New York Stock Exchange, which is a major exchange. So, why is Magnachip selling more shares? The company says they plan to use the money for general corporate purposes. This is a broad term, but they've given us some clues. They might invest in things that help them grow strategically, specifically mentioning technologies that support AI data centers and robotics. This is really interesting because AI and robotics are huge growth areas right now. It suggests the company is looking to tap into these booming markets. To make this happen, they had to file something called a shelf registration statement. Think of this like getting permission in advance to sell shares. They filed this back in June of 2026, got it approved, and then on the same day this agreement was announced, they filed a related document called a prospectus supplement. This is all standard procedure when a company wants to sell more stock. It signals that they are ready to act and raise capital when they see an opportunity. This is a crucial point. Magnachip is not forced to sell any shares. They have the option to sell them if they choose to, and if the market conditions are right, this means they can control when and how much they sell, which is good. They are not being forced into a sale they don't want. The sales agent, B. Riley Securities, has agreed to do their best to sell these shares. They will follow Magnachip's instructions on things like price, timing, and how many shares to sell at once. This ensures Magnachip maintains control over the process. Like most agreements, this one can be ended by either side with proper notice. This means the deal can be called off if circumstances change, which is a standard flexibility clause. This section just tells us what other documents are attached to this filing. These are the official paperwork that backs up what we're discussing. This is the actual sales agreement itself. It is the core legal document that outlines the details of how Magnachip can sell its stock. This is a legal opinion from a law firm. Basically, they are confirming that the shares Magnachip plans to sell are legally valid according to securities laws. This is another layer of formality and compliance. This is the consent from the law firm to use their legal opinion in the filing. It shows they agree to be cited. This is important for digital filing. It is a data file that allows computers to read and process the information in the filing more easily. For the sexy and financial analysts, this is how they crunch the numbers. And here is the signature, showing that the company is officially submitting this report. This is the signature of Shinian Park, the Chief Financial Officer of Magnachip. Their signature means the company leadership is aware of and approving this filing. So, what is the big picture here? Magnachip is a semiconductor company looking to raise up to $50 million. They're saying they want to invest this into growth areas like AI and robotics. This move, called an at-market issuance or ATM program, is essentially a way for them to sell stock gradually as needed. It is a common tactic for companies that want to have cash ready for opportunities or to fund operations. Now, let's consider the context. Magnachip has a market cap of around $192 million and a current stock price that has seen a decent range over the last year. We've also seen recent headlines talking about their iServer portfolio and how investors are bullish about it. This filing seems to align with that narrative as they are raising money to invest in those very areas. However, selling more stock even gradually does dilute existing shareholders. It means that each existing share will represent a slightly smaller piece of the company. If the company uses this money wisely and drives significant growth in AI and robotics, the dilution could be well worth it. But if the investments don't pan out, Existing shareholders could be left with a larger number of shares that are worth less overall. Think about it this way. If you own a pizza and the company decides to cut 4 more small slices and sell them, your original slice gets smaller. But if those new slices are part of a plan to make the pizza even more popular and valuable, then your smaller slice might eventually be worth more than your original big slice. That is the hope here. Historically, companies that use ATM programs to fund growth in aggressive areas, like AI, can see positive results. But it is not guaranteed. Success hinges entirely on the execution of their strategy and the market's reception to their new technologies. What I am watching for is how quickly they deploy this capital and what tangible results come from their investments in AI data centers and robotics. If they can show a clear path to revenue growth and market share gains in these high-demand sectors, this stock sale could be a shrewd move to fuel that expansion. However, if the money is just absorbed without producing clear growth, it could signal trouble for existing shareholders. The risk for current investors is that the dilution doesn't lead to proportional gains in share value. That is my take. Stay decoded. If you found this breakdown useful, please like this video, subscribe for more, and check out the resources in the description.